Lowe's companies reported somewhat disappointing results for the third quarter of fiscal 2023, but more importantly for the full year as well. However, the weaker performance of Lowe's compared to its larger rival Home Depot was somewhat expected, and investors should focus on the long-term performance. Lowe's is currently trading at $198, down 3% based on the earnings news. Year to date, they are down 0.5%, so roughly trading even. As you can see, it's been a bit of a roller coaster. Zooming out to 1 year, they are down roughly 6%. Looking at the performance versus the S&P 500, they have lagged behind quite a lot over the last year, but if we zoom out to 5 year, for example, you can see they've actually outperformed the index by quite a lot. If we look valuation-wise, you can see the PE non-GAAP 4 ratio sits at roughly at 15, which is below the 5-year average of 17.5, roughly 12%, so could indicate a potentially good opportunity at the current time. Jumping into the dividend stats, you can see it offers a 2.15 dividend yield, 4.4 annual payout, and a payout ratio below 60%, which is my cutoff threshold basically, at roughly 32%. 5-year growth rate of roughly 20% and a dividend growth streak of 60 years. So taking a look at the history, you can see here, it only goes back to 2005, 2004 roughly, so obviously this is not the full story, but it looks kind of like how we want it to be, up and to the right. Now, paying out $1.10 every quarter. While the dividend streak for 6 years is a massive achievement and the 30-something payout ratio is also looking really sustainable, we do however want to check the financial statements to gauge whether or not it will also be that way in the future. So jumping into the income statement, you can see here revenue-wise, we want them to grow there. You can see here back in 2019, $71 billion, up to $90 billion in the last 12 months, even had a peak of 97 in February. Coming down as well, we do want to check the net income if that is also growing. $2.3 billion back in 19 and up to 7.6 in the last report, also looking extremely nice. But as mentioned time and time again, dividends is all about that free cash flow. So jumping into the cash flow statement and scrolling down to see how they use this net income, you can see here down to cash from operations, roughly similar number, 7.4, and the capital expenditure sits at 2. So taking a look at the history here, you can see 6.1 up to 7.4, 1.1 up to 2, and has a lot of values in between. So it looks like they have a pretty steady cash from operations as well and are generating a lot of free cash flow. Jumping down to the bottom, you can see here that the free cash flow per share sits at 9.16. And if you remember from the dividend stats earlier, the dividend was at 4.40. So indeed, a lot of free cash flow per share. So obviously very sustainable for them and also to grow in the future and also to invest in the business. Before we jump into our intrinsic value calculations, I do, however, want to check how the Wall Street analyst thinks about it. You can see here 36 analysts over the last 90 days. 17 has a strong buy, while 14 actually has it as a hold. So there are some divided opinions about it. Let's jump down here to the price target. So you can see average price target of 230, 16% upside from the current levels of around 200. So it looks like some of the analysts at least think there are some upside to lows from the current levels. And if you do believe that as well, maybe this could be a potentially good time to buy in. But let's check that using our stock screener. So let's jump in here. So you can see we have our key metrics on the left. And as mentioned, we have gone through the PE ratio and so on. Jumping down to net debt to EBITDA, sits at 3.02. So in general, this would be below 3, but I think it's a pretty healthy, pretty okay standing point to have it right now. I think they are probably trying to get this down as well, as a lot of our companies are doing as well. So not a big of an issue as it could be, but I would definitely check further into how this debt is structured. Return on invested capital, really nice as well, 26%. Return on equity, double check this number. Obviously minus 45% isn't really good, but the 5-year average sits at a very, very nice number of 93%. And this is something I've looked forward to touch upon in this video. Look at this operating margin growth over the last 5 years. 13% they managed to grow their operating margin. That is massive for a company. So indeed generating a lot of money. And again, some of the dividend stats, as we touched upon before, the current yield above 2%, payout ratio sits at a very healthy percentage in the 30-somethings, 3-year dividend growth rate of almost 25%, and a dividend growth rate streak over the last 5 years of roughly 20%. Let's jump into the dividend data tab, zoom in a little bit so we can see everything a little bit better. So what we want to see here is basically some steady growth, and they are indeed growing dividend, as mentioned, roughly 20%. So if you take a look at some of the individual dividend growth rates, you can see that they had a very big one from 21 to 22, 32%, but still they are looking pretty nice, I say. They're really even. They had not a huge one, I think, during COVID. Obviously, I think anybody can understand that one. So we are looking at all the other years basically. So 23, 24, 2017, roughly pretty steady around the 20% mark. So coming down here to the dividend yield graphs, you can see whenever we get above the line into the blue area, it could indicate it being a potential undervalue. And as you see here on the left, the graph says actually roughly 18% from the current level. So again, it could indicate that it could be a potentially good buy for Lowe's. But let's jump into our different valuation models. We have a lot of them, such as a discounted cash flow model. Let's zoom out a little bit here, so you can see every bit of the estimations that I have used. I'm not going to go through every single one of them, but we do have the discounted cash flow model. We do have the dividend discount model, the multiples valuation, Graham's revised valuation, also the price to earnings model. Feel free to pause the video whenever you want to take a look at some of the estimates I've done. Free cash flow valuation, and lastly, the Peter Lynch model. Before we jump into the summary, thank you so much for watching. If you hadn't done so already, please subscribe to the channel for more videos in the future. Now let's jump into the summary, where we do have all our valuation methods. I have excluded the dividend discount model. As you can see, it is a negative number, so obviously we don't want that in here, but we do have the remaining ones that averages together to an average intrinsic value of 195. Current price being 198, I think we are very, very fairly valued. And for a company like Lowe's, I think this is probably as good as it gets. You can see here our margin of safety calculator over on the right. Normally we want to apply a bit of margin of safety to kind of be a little bit on the safe side, because we have made some estimates over on the valuation side, obviously. So we want to take a little bit extra precaution before we buy that. So as you can see, it takes some of the key metrics and either add or deducts a little bit margin of safety based on that. But as you can see, in the end, we arrive at a margin of safety 0 is needed, basically, because it's such a strong run company and they have plenty of good key metrics that could indicate that whenever this company is at a fair value, it could be a potentially good buy. So let's put in 0 over here and let's see nothing changes. That's good. Acceptable buy price around the 195 mark, which is roughly where we are at now. You could obviously wait for the last few dollars to actually get the current price to match the average intrinsic value. But for me personally, I think Lowe's is such a great company that I would not hesitate to buy at the current levels. To be honest, I think it's a very, very fair value and you are getting a very great company for a very, very fair price. I can't remember who said that. I think maybe you do. So if you know, please leave it down in the comments. Thank you so much for watching, and I'll be seeing you in the next video.